Paul Molloy from Box Clever Tax. Thanks very much for joining
Thank you.
joining me on the Informed Decisions podcast. And we're doing obviously a video podcast here, so make sure to behave yourself. You are on screen. Paul, how are you today?
I'm not too bad. I'm not too bad. Look, if you weren't busy at this time of year working in tax, there'd be something very wrong. It's just. I suppose it's a time of year where people, I suppose, do their income tax return, and it's just a time of year when people start thinking about tax. There's a number of deadlines towards the back end of the year, so you'd love to be, have more inquiries at earlier stages of the year, but it's just the way it is. And I don't think our industry is that different from anybody else. There's, the restaurant trade too, I'm sure, 30-40% of business in December alone, So it's just how it is.
That's how it is. And so Box Clever Tax, what do you guys do or specialize in there, Paul?
Well, it's just tax. So we don't do any accounting work. We don't do bookkeeping work. If someone comes along to me with a trade, I usually send them elsewhere to some of the accountants, the good accountants that I work with. So it's just really tax. So obviously, look, there's some income tax returns, no great complexity in that, although some of them do have different slants, and that's why they've come to me specifically. Some crypto people have come to me over the years with, they've got maybe a rental property, but they've also got a load of Bitcoin, or they've got a load of a coin here and a coin there, and that's been an interesting one. Share options is becoming a little bit easier for employees. There was a time before the recent changes that an employee would have to handle all the documentation with revenue, and a lot of the time that didn't get done, or it got done much later. So that's revenue have realized that it's better to take it out of the employee's hands. And from a share options point of view, going forward, hopefully the only thing you have to worry about is when you sell some shares. And then you've got some capital gains tax, hopefully, if you've made a profit. So, it really does vary. I mean, you mentioned just when we were chatting before, the SME sector, I suppose, is the main sector that I deal with. And you're looking for ways to help people pay a bit less tax. And one of the most common ways is to avail of the capital gains tax reliefs, retirement relief, entrepreneur relief, that when you close down or sell a business, you can pay 0 or 10% tax at worst if you qualify for the reliefs. And you're trying to kind of say to people, don't be taking the big salary if you don't need to take one. Let that cash build up in the company. Your exit date in your head is 5 years away. You're going to close down. You might sell. Who knows? But if you take big salaries, there's only so much I can do for you. So that's generally what we're trying to kind of shift people away from salaries towards building up cash and closing down the company someday, because the reliefs are fantastic. They're really, really good.
A lot of the SME business owners that I'd work with are very slow to take big salaries because they don't want to pay the big tax that goes with the big salaries. I guess it's case by case, right?
No, exactly. Well, I mean, like some people, they can't really help it. Like maybe there's a big mortgage, and there's a few kids going to creches and
private school.
I remember with my two, when the second one went in, it was $2,000 a month. It was an absolute killer. So sometimes people can't help it, but then there's also times people can't help themselves either.
True.
And there's only so much you can do. But most people, like you said, if you explain these things to them, and like you said, they don't want to pay unnecessary salaries, and they have that flexibility. If they're in a limited company structure, they have flexibility. If they're a sole trader, they don't, because that's the same as being an employee. You're taxed on everything. So it's the ones in the limited companies, that's who we can help.
The Box Clever Tax, it's a catchy name. Set it up in 2018. What drove you to set it up? And I believe you were Deloitte trained and 20 years in the industry.
I wasn't really. I wouldn't say it was early 2020 that we really got going. I got the idea all right, and there were some jobs that I was still working. And I think if anyone is listening to this and is thinking about going down the self-employment route, my experience is that it's best to do it half and half. So to go part-time working, but give yourself the 20 hours you're going, 20, 30 hours you're going to need to get the business off the ground. I see some people I know reasonably well, and they're working full-time in another job. it's just dipping your toe. It really is dipping your fingernail in the water. You can't get a business going like that. You just can't, unless you want to work 80 hours a week, and you'll just drive yourself into the ground.
Yeah.
So that 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 was something that I felt I needed to do, and I was lucky I mean 2020 was just a complete wipeout for me because COVID, and there wasn't really a chance to meet anyone. So I took it
I was
upon.
about to say what happened in 2020. Anyway,
Yeah,
yeah, it's
yeah,
amazing how we forget.
yeah, COVID. And so I said, well, I felt I knew my tax well enough to go out to the marketplace. But I
Okay.
said, well, what about knowing it better than anybody you meet? That was the
Mm,
standard I met. I want to know this better than
nice.
anyone I meet. And it's often my partner Grania. She often talks about just those days during COVID when it was just 9 o'clock I'd be there, to 6 o'clock I'd finish. It was just it was just me and the books. But
Yeah.
what I was doing was I was gathering knowledge and getting ideas and thinking, what if this person did this and what they did that,
Mm.
So it was very, very useful. And then I picked up that part time work early in 2021. I'll never forget that I got a call from a lady called Karen McKeown in MSA, and that gave me the perfect platform then that there was money coming in to pay some bills, and then I could go out the tax. That was just perfect. Where I got the name, I think it just I don't know, it just kind of came to me one day. I thought it was a bit corny. In fact, can I tell you my corny tagline?
Please do.
And actually, there's a chap called, shout out to Marcus Doyle, who knows his tagline better than I do, actually. And that says, helping you give revenue a pay cut in 2024. So, the idea that I'd be like, helping to to give revenue to some kind of 10% pay cut, it just, it's a lovely idea. And lovely.
Mission, your new mission in life.
Yeah, yeah. Well, I suppose if I was able to knock out 10% of the revenue, I'd probably be on a different kind of list known as a kill list. So,
It might disappear. Yeah.
yeah, yeah, yeah. I find people in revenue generally very, very good.
Yeah.
Generally very, very good
Yeah.
to work.
Fair. Yeah.
Yeah.
Yeah. And I'm very good friends with a lady who's got a fair job in revenue, and she's smashing. So, okay, so this is what you do. You work with SMEs on a day-to-day basis, helping to reduce what they're paying to revenue and tax, and be smart about what they're doing. I guess ultimately, really interested to touch on a couple of different areas. One being property. All right. I came across you recently enough on LinkedIn. You'd put up a really good, concise video, unlike my own. It was really concise and to the point, explaining the differences between owning property within a
Mm.
company versus owning it personally. And this is a really interesting topic that I get. If I had €1 for every time I was asked this, when I'd probably have €20 at this stage, it's not a huge amount of money, but it is a realistic number.
Yeah. Yeah.
Give us the breakdown, okay? If in terms of owning a property, or then these are investment properties that you probably rent out, right? Ideally, in a company versus in your own name. Let's go there.
Yeah. So, the the main reason people end up owning property in companies is because that's where the money is at the beginning. The money is in the company.
Okay.
So let's say we need to take out 200 grand for a deposit on a €1 million building, and the bank's going to lend us 800,000.
This is as a company now or as an individual you're talking about here?
But we're going to do both. So
Okay.
let's take it as a company for the moment.
Okay.
So
So
the
there's £1 million
company,
of a property.
there's 200 grand in spare cash in the company. That's the
Okay.
deposit, and the bank will give 800 grand of a loan, and that's there. You're there. Well, ignoring stamp duty and costs and all that kind of stuff, you're there at €1 million. If you want to buy it personally, you possibly have to take 400 grand out of the company if you don't have spare cash around. And that's obviously a huge hit, and that's what puts people off so much.
Yes.
And they
That
say, well,
200 grand tax bill to get the deposit, right?
killer, absolute,
Yeah.
absolute killer. So people go, well, I, maybe I only got 200 grand in the company. So that's what they do. And certainly another advantage for the company is it's a lot easier to pay the rents because the company owns the building, say.
Mm-hmm.
And let's say it's commercial, like it's like a warehouse, and the rents every year are 100 grand or something like that. Like it's the paying the mortgage is an awful lot easier. Because if we go back to the guy that has it in his own name, he's got to pay tax on the rental income, but the principal, the repayment of a loan, that's not an allowable expense. So now what he's a management fee, maybe he's got some repairs, maintenance, maybe an accountant fee or something like that, and then the interest. Now at the beginning of a loan, the interest is normally very, very big, so
Yes.
that's not as big a deal. But as time goes on, it becomes a much, much bigger deal.
So you're referring to the fact that you can get 100% income tax relief or rental income
Yeah,
relief against the
property
interest that you're paying on the
in the company.
mortgage, right?
Yeah,
Yeah.
so that's
Okay.
that's that's what seems so appealing about the mortgage. But the people don't understand the corporation tax.
Okay.
And when let's say the rents are 100 grand, the corporation tax is not 12.5%. People think it's 12.5%. It's not. It's 25. And the reason it's 25 is that property is considered a passive income compared to, say, my business, your business, somebody who owns a restaurant. Someone who owns property, is treated as if they're, on a sun lounger in the Caribbean, just playing with their phone, So, that's all they're doing. Now, I assure you, anyone, and you know better than I would, buddy. People are doing far more than that, but it's treated that way. It's treated that way. So now you're down 25 grand in corporation tax, and that's not coming back.
Okay.
The next thing is there's the close company surcharge. This is estate and investment income as it's described in the legislation. I think it's 440 in the TCA. And it's effectively another 15% on top of the 25. So now you're down 40 grand.
And does that those company surcharge apply in all situations?
Yeah, it applies if you leave the money in the company. So if you paid your corporation tax at 25% and then
Sure.
immediately took a dividend within 18 months of year end, then that surcharge goes away. But a lot of people want to try and build up cash if they can, and they say, well, okay, the surcharge is a stinger, but like I need to do it. But you're down 40. So there's no I talked earlier about, capital gains tax release. If you close down a business, if you're SME, depending on your age, could be 10%, could be 0%. They do not apply to a property business. So you're going to have to take that remaining 60% out as a dividend at some point.
It's still in, yeah, exactly. It's still in the company, right?
It's the
You're paying
company.
40, potentially paying 40% on the revenue, and and the cash, the remaining is still in the company, right?
Yeah, it is. So now anyone watching this who's in the pension world will say, and quickly say, well, you could make a pension contribution, and absolutely you could do that, but pensions are deferred tax. They're not no tax. You build up a pot of money, and later on when you're in retirement, hopefully it'll only be at 25-30% tax, but it's not going to be no tax, and it could be at 50% tax. So you really don't have great options when it's in the company. And it all goes back to the fact that it was just so difficult to get the deposit in your own name.
Okay.
So if you have this in your own personal name, you're paying 50% tax every year, which
The
obviously
income.
is rough. Well, it could be 47, it could be 52. It depends on where your income is. But the the point I was making is that if you've only got 60% of the money left in the company and you have to take a dividend, that's 50% or marginal tax on your 60. So you end up with 30 if you keep it in the company. At best, you get, if you take your money out at the 25% point, well, you're still paying half of 75, which is about 37.
Okay.
So 30 or 37 or 50. Like everyone knows that 50 is better than 37 or 30. And it's the corporation tax people don't see. And that's year after year after year after year after year after year. So,
It's not as clear cut as people might assume. cash in business. Let's go and buy a property. I think there's different scenarios. I think that pop up, and of course, as you'd be the first to say, look at different scenarios will have different circumstances, and therefore different factors, and will influence the decision. In scenarios where there is a lot of cash in the business, and the business might decide, for argument's sake, to would not have to borrow. Let's buy a property. What about the situation where the business buys a property in which to do business? Is it
Oh,
therefore then a qualifying business asset and all
yeah,
the
yeah. There's
potential
no
advantages around it?
there's no corporation tax in that situation because it's just an asset.
Hmm.
It's an asset of the business. Now, there's no corporation tax, but there's no return like in the
Yeah,
way that there's a rent either. So let's say you buy a warehouse and you're saying, well, we'll need half of that.
sure.
So half of it's yours and you're using it for your business. You're not getting anything for it. So of
Hmm.
course you're not paying any tax. And then the other half of the warehouse, somebody says, "Can I rent that off you?" And you rent that out. Well, you're back to your rental income. You're back
Yes.
to your 25% corporation tax, 15% surcharge. So it's certainly better. And with I don't think it applies to entrepreneurial relief. I'd have to check, but I know with retirement relief, if you own
Hmm.
a property that your business uses and you
Okay.
want to, pass on valuable assets to your family or to sell or cash out yourself, you can include that property as part of the overall. Now, you only have about €1 million to play with when it comes to retirement
Yeah.
relief. How much is a property going to be worth? Half of that at least. So, but it is one of the cases. And I had a situation. Somebody came to me and he had sorry, she had like 10 properties,
Okay.
and she was she was working. I think she was a solicitor. She was a solicitor and she had 10 properties, and she was also a sole trader. And she was
Mm.
going, "I'm getting killed on tax. Like, is there anything I
Yeah.
can do?" And she goes, "Can I not put my companies into my properties into a company? Surely that would save me a lot of tax."
Mm.
And I explained to her, based on what we've been talking about, there's nothing that will do to help you. That will only that will only add to your tax bill. But what we were able to do is to show, well, what if you incorporated your solicitor's practice? Now, I think there could be issues around
I don't think they
solicitors.
can, right?
Yeah,
Yeah.
I think there's issues around solicitors, but
Yeah.
it's an example of, let's say if she was an auctioneer or she was an accountant or something like that. Um, what she could have done is use the money from the properties, because I mean, for 10 properties, if you can't live off the money from 10 properties, I don't know what to do for you. So she was able to take, a business will be able to take no salary from the trade and just live off the rents, and build up the cash in the company. Because I mean, the solicitor's practice would qualify, So I mean, the problem is that with any sole trader, you are being taxed on everything anyway. So
Yes.
it's difficult to build up cash the way that a company can. But that is one of the ways of doing it. So somebody comes to me with property. Like, the first thing I'm
Mm.
saying is, what's the day job? What's your day
Yeah.
job?
Okay.
Oh, I'm an auctioneer. I'm this,
Yeah.
or that, or working in property. As a one guy was working in property as an employee, and I said to him, "Could you be a contractor? Would they have a problem with that?" And he said, "Well, they probably wouldn't like it, but I don't think they'd have a great difficulty with it." And they
Okay.
didn't, and they didn't. So he incorporated that business, took
Right.
next to no salary,
Okay.
and lived off the money from his properties. So
Okay.
it's
Yeah.
the circumstances that happened. A lady I know, she had a flower business and she had a couple of profits, and it was exactly the same. Is exactly the same thing. It was incorporate the trading business
Okay.
and live off the
The
live off
rental.
the rents from the properties.
In I've seen scenarios where people might have three, four, five plus residential investment properties that they picked up over the years, right? They obviously have a fondness for investment property here in Ireland and the rental incomes, and they believe it's a prudent, long-term, passive approach. We all know it's not that passive all the time, but in theory, right? So, in those situations, I've often been asked the question, and I'm not the tax advisor, of course, but should I put these into a company? And in that scenario where it's not, hey, I have a company and I have cash and I think we want to buy something, it's I have these properties in my own name. I'm paying very significant amounts of tax,
Yep.
irrespective of mortgage and interest relief, etc., and expenses linked to the properties. Is it more advantageous for us long term to put them into a company or not? What are we saying there? Are you
So
saying blank no?
I'm saying hell no.
Hell no,
Hell no.
really?
Right. So like the first thing is, what's the latent capital gain on those properties? So if that person's got three or four properties, particularly, since about 2012, I think Irish property has been rising. So that's 12 years, give or take.
Okay.
I'm not sure the exact moment when the market,
Yeah.
but that was around that time. So, if they bought those properties in and around that time,
Yeah.
they probably increased in value
Oh yeah.
quite a
Oh
lot.
god, doubled at least. Yeah. Yeah.
Okay.
Yeah.
So let's say they bought them for 500 and they're now worth 1 million.
Yeah. Okay.
If they put those properties into a company, and it doesn't matter whether it's one company or seven, right?
Okay.
Let's say, just keep for simplicity, say it's one. There's no tax relief on that. They've made a disposal. They have sold their properties to a company. Now, they may well own this company, but there's no tax relief around that. So now they've just created a capital gains tax bill of 33% of 500 grand, which is 166, I think.
Okay.
So that's an awful idea, right? But
Sorry. So that's the first hurdle they have to cross,
that's the
right?
first hurdle. I'd say that was a pretty high one.
Okay.
But after that, we're back to the issue of, by holding them in a property, they're losing 25% of the rent straight away.
Okay.
If they keep the money in the property, and it sounds like they probably would want to,
In the company, yeah.
in
Yeah.
the company, that's another 15 grand, 15%. So
And right in that scenario, let's say the rental income currently coming in, held personally, is in obviously it's in their name. So rental income that's coming in, they're taking that, they're paying tax on
yeah,
that, right?
yeah,
You're saying, well, if you put them into a company,
yeah,
and I've just checked it there, house price inflation, according to one side, it's 101% since 2012, right? So it's doubled essentially, right? Again, that's an average, right? So blah
yeah,
blah blah.
yeah.
But in theory, I own the properties at the moment. There's 150 grand gross income coming from that. We're paying tax on that income, so we're netting whatever we're netting, right?
75. Yeah,
70. Okay.
yeah.
If we put it into a pension, we'll have to pay. What did you say? So there's a trigger there. There's a taxable
Yeah, I mean,
event.
the pension is an idea. The pension is an idea. Now, the only thing is, if you have somebody who has a lot of property, then let's say they've got an income in retirement on the property of like 80 grand.
Okay.
If they have a pension, everything the pension earns is going to be at the marginal rate of tax. Even if the pension is 20 grand a year, 20
Oh,
grand
yes.
plus 80.
Yeah.
So, your first 44,000 next year is at 20%. The next 36 on the 80 is at 40%, and
Okay.
everything. So this is the thing about a pension, And I look, if I was working in the industry, I'd be trying to. I'm not saying I'd be trying to hide this fact, but I wouldn't be blaring it out there. But anyone I speak to, I don't. I'm going to tell them facts. You want to have a nice mix between these things, and if you've got property
Sorry,
that's
are you saying you can have too much income? Basically, is that the point?
you can put, to go back to the decision you were just talking about.
Yeah.
They've got a lot of income tax, so they say, well,
Yes.
I'll pay a pension of 20 grand, and
Okay.
at that moment, that will save them tax of 10,000.
Yeah. Okay. Yeah.
But roll to the time in the future when they're going
Yeah.
to be taking that money, they're
Yes.
going to be paying tax of 10 grand
Yeah.
on
Yeah.
that 20.
I have you. Yeah. When they draw
So
down, absolutely. Yeah. But look, again, I suppose pensions are something that we spend a lot of time trying to figure out for people potentially. And again,
I,
depending on the scenario, right? Is if it was a PRSA, you could delay the drawdown until 75 if you needed to, right? If you die before that, the full value passes out to the estate as tax free,
I mean,
cash, right? So it does depend on the scenario. But I would 100% agree. You you there's such a thing as too much income, right, in retirement, right, beyond what you need or want to
well,
be
it's just
drawing.
how much pressure are you put like if you want to pay 20 grand in pension, you get 10 grand in tax relief, which
Yeah,
is good, but the
yeah,
other 10 is gone.
yeah, yeah.
So what I don't like to see is people putting themselves under too much pressure
Yes,
to kind of fund
yeah,
a retirement that hopefully will happen. But I don't think it's a problem to have that extra tax. But I mean, knowing that you have these properties that you're probably going to hang on to them, the one area where pensions I think is definitely worth thinking about is if you drew down your pension or you were 65 in 2008, you didn't want to be drawing down your pension at that point, or if I think about my dad, I hope he won't be cross at me for saying this, but he worked in commercial property and a number of sites, and sure the tenants were gone, like they were out of business. So that's where having the pension actually would be a good thing,
having
because you could have
diversification.
3 or 4 years of being completely skint.
Yeah,
And ever since Nixon took America off the gold standard, it's not something people know much about. But what it's created since is, without other than the euro, permanent floating exchange rates. So we've had massive volatility. 73 we had the oil crisis, 79 another one. 79, Paul Volcker increases interest rates to 20%. 2 years later, Latin America's wiped out. 87, the crash in 87. 90 sterling. We had our own crash. So if you look the 30 years since Nixon did that to the 30 before, like it's become such a volatile world. Like, and I teach a class, and I'm trying to get it across to students that we're in a world where people say, 2008 could never happen. Like,
yeah.
it could, because there's, I'm already beginning to hear things on Wall Street about deals being done or new structures being done that it sounds like the 2008 stuff, the
How do you?
subprime.
I want to come back to this point, right? But just to before we move off the topic of the properties into a company piece, right? We're saying individuals have rental income on properties that they hold in their own name. Potential, and that question is, should I put it into a company? If you put it into a company, you're saying there's a taxable event, you'll pay CGT if there's gains on putting it in,
If they
right?
bought it in 2006 or 7,
Yeah,
maybe
yeah,
the gains aren't there. Maybe it's not as big.
exactly. So there's potential, right? But
Yeah,
depending on when they bought it,
yeah,
right, and the values, right? No, but that's a potential consideration. Once it's in the company, as you're saying, there's corporation tax on the income. There is closed company surcharge
surcharge.
potentially, all right, on
Yeah,
top of
especially
that.
that. Yeah.
But what my question is then if they want to draw an income from that company to sustain them, they're going to pay tax on that income personally as well, right?
Sorry. Yeah.
So
An
it really
investment
does.
company,
Where's the logic, right?
yeah, an investment company is very limited in terms of the amount of salary that can be paid, management expenses, somewhere
Yes.
between 10 and 15. 15% would
Okay.
it's at the high end of what revenue will accept.
Really?
So you're
Okay.
back to the dividend, really. Really,
Yeah.
you're back to the dividend. So
Okay.
it's just, I had this scenario recently with chaps that were trying to buy like a restaurant or something like that, and the money was in their companies, and I did a piece of work for them, basically begging them to go down the personal route.
Okay.
That was where the money was. They couldn't come up with a deposit without
Yeah.
by going down the personal route. So
And instead of going down the property route, if you have cash in the company, is there an alternative that you have a preference for people to do from a
Well,
cash flow accumulation exit
yeah, yeah, yeah.
perspective?
I mean, look, I certainly I'm not an investment
Yes.
advisor. Like most people who go to the racetrack, I'm probably wrong more than I'm right, which is bad given the law of averages. But when it comes to a trade, um, let's say an auctioneer just comes to mind. Someone's putting away or making sales of about 120 a year, and they can live on a salary of 40. That means they can save 80 a year. Now, they'll pay 20% of that in tax, so 12.5% corporation tax, and the surcharge is a bit smaller for professional firms. So 20% of 80 is 16. So 64 grand can go into the company bank account after
Okay.
all corporation tax is paid.
Hmm.
And, you know, 10, 12 years later, that's going to be about 750, 800 if they
Okay.
keep that up. And that's what I'm always encouraging people to do. So if you're over 55, you've owned the business 10 years, which a lot of owners will have by the time they get to 55.
Yeah.
Um, then if there's 75 grand or less in the company, you pay zero tax on that if you either sell it or liquidate it. So that will beat any pension. It beats anything really. In terms
So,
of the
sorry,
750,
say that again. Sorry, if there's 75 grand or less in the company, you say.
750 grand,
Okay.
750.
And so, what's the revenue's view on people just clearing cash out of businesses in that instance? Because I hear conflicting guidance, tax guidance on this consistently, in terms of what is and isn't allowable. Some say 1 year of turnover, others say 2 years, others say 6 months. Is there a line in the sand or a test case here that people could get clarity from around that?
I mean, retirement relief has been around
Hmm.
25 plus years, something like it's been
Yeah.
around a long, long time. And the limits are there. It's very clear in revenues guidance around retirement relief. There's two types of retirement relief. One is where you sell to a third party.
Hmm.
That's Section 598, and then Section 599 is you just dispose to your family, your often children.
Yeah.
Um, but like both the guidance on both says that liquidations are accepted if it's if it was a trading company, like
Hmm.
a restaurant, a
Business
nail
term. Yeah.
bar,
Hmm.
not the property companies that we've been talking
Yeah.
about. Then there's nothing stopping that. Entrepreneurial Reef has only been around really properly since 2016. They made a bit of a mess of it in 2014, but they came back with a better version in 2016. I've spoken to multiple people that have claimed that, and there's no
Okay.
issues.
Yeah. Okay.
It's a spur to innovation. If you didn't have reliefs like this,
Hmm.
you're kind of thinking, is there a point? Like, you've
Yeah.
gone to all this effort, like just be an employee and go home at 5 o'clock. And so I don't see them taking away. There was a bit of I would call a Sinn Féin scare. There was definitely most people you spoke to in the last year or so were nervous about these reliefs being taken
Yes.
away, and
Yeah.
I was never really that nervous about them. And it's obviously now looking very unlikely given the current opinion polls. But
Hmm.
I never thought they were going to do something mad like that because
Okay.
it can have very very negative consequences. What have you saved? Like, if people stop doing this, then you don't get any tax because they've stopped doing it and they've gone and done other things or they've left the country or something like that. Like,
True. They'll
maybe
go elsewhere.
they could, yeah. Maybe it makes you feel better to kill the rich guys or whatever. But most of the people claiming this relief that I know, they're not rich.
Um, okay. So, in terms of volatility, you mentioned there's a lot of volatility, and that's been around for quite a while indeed. For people that you work with, is it cash? Is it, or how do they try and prepare for that? Or how do you suggest people try and prepare for that type of venture? Is diversification, as you were touching on earlier on? Is it having different income streams and different asset allocations? What's your
I,
views or
I
thoughts
think you've
around
got
that?
to look at the person's entire picture.
Yeah.
So I'll spend a lot of time talking about, tell me everything. Tell me,
Mm,
what are your plans? Do you get on with your daughter? Do you get on with your business partners? Everyone, you need to know all these things because all these things have the potential to create difficulty. My job really is to advise on the tax
Yes.
um, aspects of that. I think I think investment is a really interesting area, but it's not one I'm qualified to advise on. I mean, I do
Sure.
know I would have one client who's done extremely well out of gold,
Yeah. Okay.
over the last while, but there's any at the moment that an investment suddenly starts looking good, it's probably too late. The
To be
returns have
bailing.
probably, yeah, the returns have probably been made.
Quite
And it's
often.
it's
Yeah.
it's it's like JFK, was it Joe Kennedy in the 30s? He used to buy these companies, and he'd be there in Time magazine saying what a great company it was, and all these people would rush in, and he'd sell to them, and the company would go to zero.
You'd be going out the door as they're coming in. Yeah.
So if you can go down the Joe Kennedy route, that's going to work out very, very well for you. But we are in a different investment environment these
Absolutely.
days, and um, I think I suppose there's the most important thing anyone has is their ability to earn money. You
Hmm.
know, that really trumps, for me, it trumps anything.
Hmm.
No matter how bad things go, the amount of people I've spoken to that were like buried in the ground by the banks in the crash, buried, and they fought their way back, because they know how to make money. So, inheritance tax comes up an awful lot, and I have parents go, "God, my son's going to pay 100,000 in taxes. Is awful." And I'm like, "Your son's getting 700,000."
Yeah. 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 It's an
And you're
interesting
worried,
one. Yeah.
and you're worried about the 100?
Yeah.
Really?
Yeah.
So that's an education piece with parents, is just to remind them, you may live much, much longer than you think. Your parents didn't give you an awful lot of money,
Mm.
and your kids will have to
It'll
manage
be
because
okay.
you're the most important person here, not them.
Yeah.
You know.
Yeah. Yeah.
So that's an important
Yeah.
one.
And in my experience, an awful lot of parents obviously love their children or their loved ones or whoever it is that they're going to be their beneficiaries. But it's that constant balance and battle, I guess, of making sure that, hey, that we live comfortably and enjoy the fruits of our labor ourselves, as well as or before trying to cater for the next generation or whatever the case may be, right?
Yeah, 100%. Yeah, yeah.
Um,
There are things you can do, and I suppose I do encourage people to tell their kids what they're going to do. You know,
okay.
rather
Hmm.
than have this big surprise the day the will is read, and there's a lot of bitterness, um, and very often they haven't spoken to someone like me. I know a guy who sold a house for 1 million, or his house was worth 1 million. His estate had nothing beyond 1 million. He'd six sons, and he
Wow.
favoured one of the sons, and he gave that son the house. And he didn't qualify for the dwelling house relief, which he thought he
For
was going to,
God's
because the
sake.
dad died too soon.
Right.
They were living together, but the dad died too
Mm,
soon. So now he's got a house worth 1 million quid. He's got tax to pay
has to
of
sell it.
200 grand, and there's a fight amongst all the kids.
Yeah.
Absolute
Messy.
disaster.
Yeah.
Absolute disaster, and also unavoidable. Just having a conversation.
Yeah. Absolutely. That's an important thing. Um, I suppose finally for me, I did a piece years ago. Let's say it's 6 years ago. I looked at is it profitable being a landlord
Mhm.
as a one-off? You're a PAYE worker, and you're thinking, "Jizz, we should buy a house, rent it out." Let's say we have 100 grand of savings there. That's a good deposit. Borrow another two or three, whatever the numbers are,
Yeah,
and rent it out.
yeah.
Is it profitable?
I think over the long term, it's a very good idea. I think it's a very, very good idea. And the reason being, the first reason being, is when you get to retirement, if you've only got the state pension and you've got that property, the rent from that property, you'd probably be okay.
Hmm.
If that's all you have,
Providing the mortgage is cleared, right? Yeah, yeah,
assume the
yeah,
mortgage is cleared,
yeah.
exactly. So you have a house that you live in, which you could potentially downsize from,
Okay.
and now your income has shrunk right into the bottom bracket, and you're only paying, maybe an average bit of tax, 15, 20% in tax.
Hmm.
So from a long term point of view, it's a very, very good idea. Um, another reason I think it's a good idea is because I think it's a reasonably liquid asset. People say property isn't liquid. Well, when the market's good, it's liquid enough. I mean, anybody try. We're trying. We've listen, hopefully, God, we're hopefully a few weeks away from getting the keys, but you know, there's more of us out there than there's properties available.
Yeah.
So
At the moment, yeah. Yeah.
it will always generate an income. Now, the hard thing in your scenario where someone's putting in 100, which is a sizable amount of savings, um, is that it could, until that mortgage is paid on the rental, they won't see much cash. They won't, because
It might see a cost, right?
the rents, yeah, the rent, the case five income, the rents will, at best they'll probably break even, depending on how much rent they can get.
Yeah.
And that's where you'd be saying to them, listen, it's important to go out to dinner every now and again, not just be living in Lidl
Yeah.
and Aldi all the time.
Yeah.
But the moment you have that property paid off,
Yeah.
you are financially much more
Position.
secure,
Yeah.
or much more comfortable, But I think it's a very, very good idea. And I think as long as people know what they're getting into, that they're buying, don't buy a holiday home somewhere, because do you know the rental market is going to stand up? Go for somewhere near a city, near a hospital, near a
Near
school,
hospitals or college or whatever the case may
something
be.
like that, so
Yeah.
that it'll always rent. Even if the market comes down and your rent comes down,
Get something.
it's still going to get tenants, and I would say don't live too far away from the property either. If there's a problem and you have to drive the other side of the country, that's very, very messy. So there's
Yeah.
definitely hassle and stuff like that with properties, but on balance, most tenants are good tenants. Most tenants, the majority, 85% from what I hear. You'll always hear about the
You will.
problem
Yeah.
guys.
Yeah.
But I think in that scenario, I think it's a sound idea. Yeah.
Absolutely. And look at that broadly in line with my own conclusion at the time. Is actually until that mortgage is cleared, it's generally not profitable. People think, oh, we'll have money coming
No,
in.
no, no.
In fact, a lot of people end up subsidizing,
They do. They do.
in
Yeah.
my experience,
Yeah.
depending on the numbers,
They
right?
can do. Yeah. They can do. Yeah. Yeah.
But certainly, as and when one gets to retirement, in my own experience working with clients in that space, it is a nice diversified income to have, and generally quite sustainable and inflation proofed, assuming rent reviews are done, etc., etc., and it's well managed. But yeah, it can be prudent
Yeah.
over the longer term.
I think so too. Yeah. I think so too.
Any other little tax nuggets
Yeah. There's
for our
one
listeners,
thing.
Paul, before I ask you a couple of final questions?
Yeah, there's one I would just put out there, and it's something that's only really kind of come to my attention the last year or two. It's just the whole area of Airbnb.
Okay,
So
great.
Airbnb is seen as a different type of investment than you renting out an apartment to a couple for 6-7 years. It's new tenants all the time. You actively have to manage that to bring in new tenants. You've got to clean the place. Well, you should anyway. Every time someone leaves, and there's a lot more work involved. And on the basis that there is more work involved, this is being seen by revenue um, as a trade rather than a passive investment like
Okay.
property. So the corporation tax is 12.5%, and the capital gains tax reliefs that I talked about, they're all in play. There's no harm. You can take a salary from it if you want. There's no restrictions like there is with an investment company. So, depending where you are, I would say if someone is listening and they have an investment property somewhere, do a Google and see what kind of Airbnb is around the area where your apartment or house is. You could actually be in a very, very nice area for Airbnb. There's more work involved, but it's certainly going to pay better. Even if the corporation tax is 12.5% lower, even that alone is worth a lot. And the rents that you'll get on Airbnb with 50-60% occupation for the year would be well in excess of what you get in a normal rental property.
So that's you. That scenario. You're utilizing the company structure. The
You could,
property
yeah,
is within
yeah,
the company
yeah.
potentially.
You
Yeah.
could, yeah, you could. So that could be something where you have a property, now we'd have to look at things. I wouldn't want to be certain on this,
Yeah,
but
yeah,
you
yeah.
could potentially start the Airbnb process in your own name and then potentially move that business, because that's what it is now. It's a business into a corporate structure, and potentially avail of, it's called Section 600. It's where you have a sole trade business and you move it into a limited company. There
Okay.
is tax reliefs or limits on the. Remember, I was saying that there was a property worth £1,000,000 and the gain is
Mm.
500 and the tax is
Mm.
166. So there's a lot of reliefs, around stuff like that, but just not in the case of that property.
Okay.
So Airbnb is definitely something to consider because the tax
Sure.
advantages seem to be there
For now.
for now. Well, it was like the PRSA rule. I don't know if you heard about this, but the
Oh, gee,
PRSA was,
I've been shouting from the rooftops about it. Yeah.
it was an unlimited. You could put in two
Mm.
million quid, and now it's been capped.
Yeah, and that's a
Finance
reminder that I'm sending out to our clients today or over the next day or two. It's likely that will be capped as of middle of November. So there's probably 3 weeks left on that if people need or want to get company cash into PRSAs, because it'll be capped at 100%
Now,
of annual salary.
what
Right?
I would say is that's still a decent pension contribution.
Yeah. No, absolutely
It's
is.
still a lot better than the old. I forget the exact description of it, but
Well, it depends. It depends on tenure and
the
salary, but
age,
yeah,
the age
potentially the
is
other one, what the old
115
revenue
grand.
max. Yeah, yeah.
Yeah, no,
Oh,
I
the
don't.
age related. Yeah, that's a different thing. Yeah,
It's probably, had they come up with this at the beginning,
mm,
people would have thought, "Well, that's a great idea." But
mm.
now, because it was open season, now people are going, "Oh no!" Like
Yeah, yeah.
I was
I,
just about ready to pull the
so
trigger.
much for pension. So much for pension simplification. They've thrown another rule and guideline and kind of guardrail into the mix. So yeah, it's keeping us busy. That's for
Yeah.
sure. That's the beauty of these things. Okay, Paul. Everyone that we've interviewed on the podcast in the last number of years, anyway, we asked them for a book recommendation. Not so much a recommendation, I guess, as hey, this is a book that I read that really sticks out with me. Can be fact or fiction, any topic you like, but a book that stands out with you that you maybe have read a couple of times or that you read recently and said, geez, that was really interesting.
Yeah, no, I'm a fan of books. If you had a screen of display, my very very patient partner growing is will often say, "Not another one." Um, I think it's hard to beat Atomic Habits by James Clear. He is a guy who's been writing about the whole area of habits for a very very long time,
Mm,
and he's a big believer in starting small. So there was, just as an example, there was one guy, he went to and he was very overweight, and he went to the gym 30 days in a row, and he only went for 5 minutes. He would literally go in, get on the bike for 5 minutes, and go. And you can imagine there was a couple of people early on going, "What
What's your
beach?
man
What
story?
does he think he's going to do?" But after 30 days, for him, it was the easiest thing in the world to do, to go to the
Yeah,
gym, because he was so used to doing it.
yeah.
And it's that idea of kind of making the hard habits or the good habits easier to do, and making the bad habits harder to do. So I think that is never going to be a waste of anyone's time
Yeah,
reading that
very
book.
good, very good. I like it. Yeah, I read it a number of years ago. It's a good one. There's some great analogies and reminders in there for us that we could all probably revisit regularly.
Definitely.
Paul, thank you very much indeed. Where do people find you?
Um, I'm certainly on LinkedIn. I try to post. It's a little bit harder at this time of year, but I generally try to post. Looking to That would be the most obvious one. But I mean, my details are on the website boxclevertax.ie. Like, we're
Great.
looking to overhaul the website soon, but you won't
Good
be
on you.
long finding me.
Yeah,
I would say that I generally work with the people that I know as opposed to people that I don't. So maybe if you're saying, well, Paddy Delaney sent me, that would definitely help.
okay. Good on you. Well, Paul, thank you very much indeed for giving us your time and your insights today and what is a busy time of the year for us all. So do appreciate it.
No worries.
And I wish you the best of luck.
You too. Thanks, buddy.
Take care.
Cheers.
Thank you.
Bye.